Coming up today, stocks continue to fall as a new trade war kicks off. Canada and China bite back. Is inflation about to rise? The media wages war. Traders pile into the VIX. I take a look at all that money and why volatility is great again. It's going to be a good one, guys. Let's go. And welcome back to Click Capital, everybody, on another weekday in the stock market. This time, financials getting hit really hard, along with a bit of a reversal in the defensive trade we've seen of late. Actually saw a few tech names pop up there today, and just looking at the daily candles on all the major indices. I still think we're close to approaching a bit of a short-term low here, my custom indicators. Giving us some buy signals, not only in the S&P, but also in the NASDAQ Qs. And unbelievably, we haven't seen this for a while. The entire daily candle today on the Russell 2000 below the lower buy-sell band here in the green. That's something we didn't even get back in August. And in fact, we'd have to go all the way back past April last year. Did get close there, but half the candle was still in the band there. In fact, it was sometime around March or even September 22. But even then, those candles weren't fully outside the buy-sell band. But they were the lows in the beginning of this new bull market that we're still currently in. So going back to today, we are super oversold here on the Russell 2000. And stick with me because in a minute, I'll show you what I bought the dip on today. But just taking a look at my S&P 500 oscillator. That is now oversold, and quite so, here at 35. We only saw lower than that back on the 5th of August when we made that big bottom. But my risk on risk off indicator also flashing red today, letting us know we're still in the dicey zone, like I'm about to show you in the volatility term structure. However, this indicator can flicker at short-term lows as well. It's more when it goes red and it stays red, like in COVID. That's a sign to be cautious and maybe step aside, wait for things to stabilize before buying again. That is if you don't want to attempt to buy the dip, but like we saw back in 2020, it can flicker on these temporary dips we get, in tandem with the S&P oscillator going into oversold territory here. So keep in mind, my custom S&P oscillator doesn't just look at technicals, it looks at market internals, market structure to determine, and with high accuracy, where we could see short-term lows. The bullish signals are much more accurate than the bearish signals, although they come in handy as well. And so this indicator is just one of 28 custom indicators I've coded myself over the last 9 years using unique data to help us traders pinpoint opportunities in the market. But just looking at the volatility term structure here on the VIX, we did spike higher again today, as I was thinking yesterday, actually getting up to almost 26.5 there. And it's kind of rare to see my reversal signals on the VIX. In fact, we didn't even get that back in August. And just going back further in history, did get a few there in September. And we'd have to go back even further, December 21 and April 22. But we still have some backwardation in the curve with the VIX 9-day still higher and the VIX 1-day as well, 24. Could very well see wild swings again tomorrow and throughout the rest of this week, as option dealers are pricing in more volatility for this week and next week than what they expect the market to move in 3 and 6 months from now. And also just looking at implied correlations, that also spiking, but could also potentially be nearing a peak as well, which we typically see at market lows. When the market has strong sell-offs, stocks start moving more and more closely to one another. And in the worst crashes, correlations move closer to 1. And just looking at my key indicator, the spread between the volatility front month futures contract and the second month, like I said, we're still in the dicey zone here, above 102. We actually climbed there again today up to 104. We can't really say we've made a bottom and the market's about to recover until the spread goes back underneath 1, and very well could spike higher again like we did in October, actually got up to 108, and August was up there as well. But we did get a rotation of sorts today. Looking at semis there, finished a bit higher. Same with biotech. Countering that, financials, like I said, came off pretty hard, 3.5% today, along with others like airline jets, defense stocks, and a bit of a sharp pullback in those defensive sectors, which might actually bode well, potentially signaling this defensive rotation may be nearing an end. And if so, that spread I showed you guys yesterday, pairs trade, long high beta, short low volatility, I would say is looking pretty good at making a bottom here. Still super stretched, over 12% below the 50-day. Buy signals, I wouldn't be surprised if this makes a sharp V-shaped recovery, because all this has to do with tariffs, right? And I think a lot of the media and even some CEOs are out there who may feel the pinch from tariffs, are kind of ganging up and trying to go against Trump and manufacture the fear and pressure to dial it down, which he doesn't actually look like he's going to do. However, more on that in a bit, just looking at some key stocks. Tesla hit my buy level of 270. I'd been patiently waiting for of late, as you guys know. And so I bought the dip today in Tesla stock. Happy to do so at these levels, and I'd love another opportunity down in this support zone as well, around 220, which would give us a gap fill from their second last earnings, which again, I wouldn't be surprised if we hit that in the coming days or weeks. We've got a lot going on out there, elevated volatility. We also just got news today. Tesla sales and Chinese have been soft of late as well. But again, I believe this is a great buying opportunity for long-term investors in the stock. Those that believe in and want to be a part of the robotics revolution with the #1 clean energy brand in the world. Or you could follow the clown clowns out there like Ross Gerber, Jim Chanos, who've done nothing but lose money in the stock, trying to short it, trying to hate on it. But I'd say there's almost just as much bearish sentiment surrounding the leader of the AI boom as well, NVDA. Getting down to 110 today. I'm looking to pick up a few shares in the low 100s, which again, we could very well hit in the coming days. And that too, I believe, is a great buy the dip opportunity. That is for those that can hold stocks longer than 2 minutes and are not scared of a little 10-20% pullback in the market. We also got some strong hammer candles in government bond yields today. There's a 2-year looking like the market bought the dip, along with high yield corporate bonds. Solid hammer candle here on volume. That's a good sign to me and increases my confidence we are close to a bottom in the market here, especially as we go into the official launch of tariffs. Not that surprising to see market get nervous going into it. And so Canada has bitten back. Prime Minister Trudeau announced a 25% retaliatory levy on $30 billion worth of US inputs. Tariffs on another $125 billion will take effect in 21 days. Mexico said retaliatory tariffs are coming Sunday. And China, once again, also retaliating, but at a much lower level. They're not looking to escalate, but they have to save face and respond. After Trump dialed it up to 20%, China imposed an additional 15% tariff on many US agricultural goods, including chicken, wheat, corn, and cotton products, and 10% levy on a bunch of other agricultural, a relatively small group of imports, compared to Trump's countrywide tariff on China. But again, just looking at the price action in markets, not the worst looking candles on the EWC, Canada Stock ETF. Looks even better on the Mexico ETF, EWW, another hammer candle. Currency markets pulled back as well. Bit of dollar strength against the peso in the morning, reversed an afternoon trade. Same deal against the loonie, peaked out in the morning before turning back. So just looking at the market's actual reaction, doesn't seem too worried for these countries. In fact, I'd say the price action to my eye actually looks like the market could be expecting a deal to get done soon, which I think would make for a great gotcha on markets. And that's the thing you got to remember with tariffs against other economic stuff that can happen. They can be reversed with a stroke of a pen. The Trump put is still there, even though the media would have you believe otherwise, because they want him so badly to fail. A lot of these journalists and many others, their hate for this man exceeds their love for their country. They'd rather see him fail than the country succeed. And that's why they keep on giving us these alarming headlines. The dollar, worst 2-day decline. Who cares? All markets are experiencing big volatility right now. But just like his first term, most economists ganged up on him as well. They can't stand the man. Trying to talk us into a recession, just like the first term, didn't happen. Scaring us with inflation, just like his first term, the lowest inflation for many, many years. But the Fed ain't on his side either. New York Fed president said today he sees tariffs feeding inflation. I think the Fed will hold steady, kind of let this tariff storm blow over before they move again on rates. But we very well could see a bump up in select products. We just heard from Target on their earnings, so they will hike prices to offset tariffs. But consumers are pretty elastic. When one thing goes up, they're just going to buy more of another thing, because tariffs pretty much only affect discretionary items. Doesn't affect consumers' rent, doesn't affect their electricity. Still plenty of local farmers they can get food from. But sure, the cost of a TV from Best Buy may very well go up, or it could actually result in better deals being done with Mexico. But just looking at the market's expectations of inflation, still pretty much bumping around the same levels as the day after the election. And in fact, looking at the spread of commodities versus treasuries, another measure of the market's inflation expectations, we're actually a bit lower than the day after the election. And if inflation was going to scream to the upside, interest rate traders would at least give some probability that rates could be jacked later this year. Instead, they're given 0% to that probability. We're now actually approaching 50-50. We get a rate cut in 2 months from now. And highly likely we could see at least 1 or 2 more later this year. Because I think overwhelming all these tariff fears is the huge structural pullback in US government spending thanks to efforts from Doge headed up by Elon Musk. They're not messing around. They're really taking the meat axe to years and years of wasteful government spending. And like Elon said today, a lot of people need to move from low to negative productivity roles in government and some in industry to high productivity roles in the commercial sector. This is temporarily disruptive, but ultimately for the best. Agreed 100%. But let's take a look at the flow of money coming out of the States to the rest of the world. And these are numbers based on 2023. However, it'll be very similar to last year and where we currently stand as well. So what you're looking at is the United States trade balances with the rest of the world. Negative means America imports more from those countries than what they export. So for example, America sent $78 billion more to Canada than what they exported to them in 2023. Mexico, $157 billion. Total Eurozone, $220 billion. China, whopping $300 billion. India, $47 billion. A select few countries countries, America has a trade surplus, but those numbers are tiny in comparison. Australia, 17 billion, and Brazil, just a couple of billion. Same deal with Argentina. And so a big part of that is all these countries impose a much higher level of tariffs on US goods than what the US does to the rest of the world. Something Trump's had a gripe with for decades now, but has just been accepted as the norm for just as long. If you wind the clock back 30, 40 years, all these emerging countries weren't modernized. China's only really been practicing their hybrid capitalist communist system for about 25 years or so now. Other countries like South Korea, India, the South Americas, America brokered a lot of favorable trade deals for them over the last 30, 40 years, really helped these economies come off the ground, which resulted in trillions and trillions of dollars being sent to all these countries over decades, in addition to trillions of dollars in US aid over the decade, sometimes literally sending planes full of cash money. And third, on top of that, America's sent trillions and trillions of dollars fighting global wars that pose zero threat to the homeland of America. No one's coming to take over America. There's more guns than people there. It's never going to happen. Point is, all that's looking to get reversed. All the trillions and trillions of dollars America's sending around the world is getting dialed back in a big way. Trump looking to level the playing field, and instead, it's been reversed. We're getting deal after deal of big money set to come into the state. Other countries investing hundreds of billions of dollars. And so, while yes, there's some short-term volatility and pain now as the market reacts and digests this, I think it just sets up for American exceptionalism accelerating on the upside. America's already been this strong while sending trillions of dollars overseas. Imagine what happens when that reverses. Because like I said, the world has changed a lot just in the last 25 years. Just going back to 2000, we can see in this global map, highlighted in the blue, are countries that had the United States as their largest trading partner. In the red was China. And so we can see how dominant America was back in 2000. Their lead over the world, much wider back then than what it is now. Because you fast forward 25 years, it's actually China that dominates global trade. And so I think Trump has every right to level the playing field. It's just unfortunate so many people on his home team are trying to bring him down. Because like I said, they hate him more than they love their country, rather shoot themselves in the foot. And so all these headlines investors have been barraged with are making them nervous as we all suffer from recency and herding biases. Got some of the most elevated bearish sentiment readings out there. And looking at high beta stocks, we're currently in a sell-off of the same magnitude we saw back in COVID, March 2020. And that's what I mean. These are more likely to be temporary fear spikes because typically when markets roll over, they do so kind of big, broad distributions. But we get these kind of quick whipsaws down. They're often on fear that most of the time doesn't materialize. But nonetheless, plenty of traders buying insurance at highs gets them every single time. Option traders creating into VIX bets, call option volume on VIX index options, also pushing up to highs. And we very well could be following a similar path in the S&P 500 that we did back in Trump's first term. For those of you who weren't in the market back then, it's kind of giving me deja vu. Similar headlines, similar rhetoric, similar fear spikes, similar volatility. S&P 500 here in the red line year to date, in the white back in 2019, both of them indexed to 100. And so comparing back to then, we could dip down a little bit further. But like I said, if things get bad enough, Trump's the master at manipulating the media. In fact, I've seen a study that no other person in history has gained more media coverage in terms of dollar value than Trump. Nobody else even comes close. He can just put out a social media post and literally within 2 seconds, the algos will react, run the market back up. And a lot of people seem to forget he does have the leverage here. Bank of Canada has just come out and said they expect GDP to fall by nearly 3% over the next 2 years because of tariffs, potentially take them into a recession. Same deal with Mexico and China. They have more to lose than America does by doing this. And I continue to believe it'll result in good deals being done in America's favor, level the playing field, and that'll be good for the American economy and thus by extension, the American stock market. And unlike recessions or other financial crises, like I said, tariffs can be turned off with a stroke of a pen. But unfortunately, like I said, many on his home team are also trying to put the squeeze on him. So expect a lot more back and forth. Trump is making volatility great again. And after Volodymyr Zelensky insulted the president and the vice president in the Oval Office by trying to criticize and question them in front of the media, can you imagine doing that? Receiving $200 billion from a country that doesn't need to help you fight a war you don't need to be in. And then you go to their country and insult them. It's no surprise to see him dial it back and said he's ready to sign a US minerals deal. But there's a lot of deeply seated interests in seeing this war continue. But like I said, there's a good reason why the military-industrial complex lobbied so hard for NATO to push up against Russian borders, knowing Putin would bite back and keep the dollars flowing for them. They don't give a crap about all the millions of lives wasted or all the money you, the taxpayer, will have to pay back with your time, with your labor. It's not just some make-up number. Will result in high higher taxes and less government spending for your own country. During the Biden years, they didn't even spend $40 billion defending their own US southern border. Spent 4 times that protecting Ukraine's border. Kind of funny if you ask me. And so that minerals deal will be good for the states. It helps to deleverage from China, who has a grapple over rare earth minerals. We also heard yesterday, $100 billion investment in the US from Taiwan Semi. Like I said, deal after deal, money's coming back to the states. How that's a bad thing, I don't know, but that's what the headlines are convincing most investors. I think the fundamentals are dramatically improving for America. And as an investor myself, I'm not rushing out to buy European stocks when they're still struggling to grow over there. But isn't it funny now the Germans realize they need to defend themselves? Now coming out with news of a $500 billion Euro fund for infrastructure spending in a tectonic spending shift to revamp the military and revive growth in Europe's largest economy. After Trump just let them know, can't keep relying on the US taxpayer for your own security. If you want the Ukraine war to keep going, spend your own money. And I'd say in good news for the global economy as well is OPEC's plan to proceed in unwinding some production curbs, thus allowing crude oil output to increase. And simple supply and demand means that should result in lower prices, which we saw today in crude oil futures, getting down to $66.77 a barrel. Right on the nose of this support zone before bouncing off a bit there. Another hammer candle out there today. But that's good for economic growth and inflation. If we can keep oil around here, it's going to help the consumer. It's going to help the chances of getting another interest rate cut. And just moving on to other markets, there's a look at the dollar continuing to fall, which probably helped gold a bit here today, reclaimed 2,900 an ounce. And there's Bitcoin. Also had a dip, another kind of hammer candle formation here. And hasn't this seen some whipsaw over the last 72 hours? Up, down, up. Same with Ethereum. Could be potentially trying to find some support here at this big zone. Jamming up here at least. And some of the mega cap tech may be close to finding a bottom here as well. Alphabet getting some buy signals. Same with Microsoft. Quite oversold here. 8% below the 50-day. Pretty big move for Microsoft. And just growth shares in general looking stretched. But like I said, with the volatility term structure still in backwardation, we're still in the dicey zone. But this is where bottoms are made. Then once we cross back below 1, it's more safe to say we've seen the bottom, which again I think will happen this week. And just how stretched we are on the Russell 2000. At one point today getting 17% below all-time highs. We go down another 3%, you're going to see the headline, small caps in a bear market, with the old technical definition. If we're down 20% from highs, that must mean we're in a bear market, which would be a great shakeout. In my opinion, if we went down 21%, get that headlines, then that could be the bottom. And if you don't believe this fear is going to last forever, then some of these dislocated spreads close in quite quickly. The Russell versus the S&P equal weight, looking like it could be putting in a low here. Just as, like I said, high beta versus low volatility. Look how stretched we are here. This candle, so far below the buy-sell band. Say we're pretty close to peak fear if we haven't seen it already. If not, I'll be happy to buy the dip on NVDA in the low 100s, maybe around 103 there, I think. Just as I bought the dip on Tesla today and would love to do so again at 220, I think would be a great level to add to my position and pick up a few shares from panicked investors who, like I said, are tamed by the market, and it's every single little movement. But with the VIX one day at 24, we very well could see some big moves out there tomorrow as we make our way to Friday morning. The jobs report, unemployment expected to come in 4%. Jay Powell speaking afterwards. I'm sure the rest of this week will continue to be interesting. And so if you haven't already, subscribe to this channel, click capital, and I'll keep you updated every day after market close with all that's going on out there. That's all for today. Thanks for tuning in, and I'll see you again this time tomorrow. Cheers.